My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject Strategic Financial Management. As prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Study tip. Focus deeply on IBC 2016, buybacks, and financial distress topics for long questions. For short questions, no regulations, theories, and processes, they are sure short scoring areas in exams. Unit 4 first important short question is Signaling Theory. Signaling theory in finance explains how a company's actions send messages, signals, to investors about its financial health and future performance. What does it mean? When a company makes certain decisions like paying high dividends or buying back shares, it's not just about money, it's also a signal to the market that the company is doing well. Easy example. Suppose a company increases its dividend. This sends a positive signal that the company is confident about its future profits. Investors may buy more shares, and the share price may go up. On the other hand, if a company suddenly cuts dividends, it may send a negative signal that the company is in trouble. Easy to remember line. Actions speak louder than reports. That's the power of financial signals in quotes. Conclusion. Signaling theory helps investors understand hidden messages behind company decisions. It plays a big role in share price movements and investor confidence. Next important short question is 2 SEBI regulations related to buyback. SEBI, Securities and Exchange Board of India, has made clear rules for buyback of shares to protect investors and ensure transparency in the process. Key SEBI rules for buyback. 1. Buyback limit. A company can buy back up to 25% of its total paid-up capital and free reserves. 2. Methods allowed. Tender offer from all shareholders. Open market purchase. Odd lot buyback. 3. Time limit. The buyback process must be completed within 6 months. 4. Debt-equity ratio. After buyback, the debt should not be more than twice the equity to 1. 5. Buyback tax. Buybacks are subject to a buyback tax under the Income Tax Act. Example. If Infosys buys back its shares via the tender offer method, it must follow SEBI rules like making a public announcement, fixing a record date, and completing it in 6 months. Easy to remember line. SEBI's rule is simple and tight. Buyback must be fair and right. Conclusion. SEBI regulations ensure that buybacks are done legally, fairly, and in investor interest, preventing misuse by companies. Next important short question is 3 characteristics and causes of financial distress. Financial distress means a company is struggling to pay its bills, loans, or other expenses. It's like a warning sign that the business is in trouble. Key characteristics. 1. Continuous losses. Business is not making profit. 2. Cash flow problems. Company can't pay salaries, rent, or suppliers. 3. Loan defaults. Failing to repay bank loans on time. 4. Falling share price. Investor confidence drops. 5. Poor credit rating. Banks don't want to lend money. Major causes. Poor management decisions, bad investments, no planning. High debt, too many loans. Market competition. Economic slowdown or inflation. Unexpected events like COVID-19, natural disasters. Example. If a company takes huge loans and its products don't sell well, it may not repay banks this leads to financial distress. Easy to remember line. Too much debt and low cash in chest leads a company into distress. Conclusion. Understanding the signs and reasons for financial distress helps companies take quick action before things get worse. Next important short question is: 4 modes and methods of buyback of shares. Buyback of shares means a company buys its own shares from the market or shareholders. This reduces the number of shares in the market and can increase the value of remaining shares. Modes methods of buyback. 1. Tender offer method. Company offers to buy shares at a fixed price from existing shareholders. Shareholders can accept the offer and sell their shares. 2. Open market purchase. Company buys shares directly from the stock market over time. Done through stock exchanges like NSE or BSE. 3. Odd lot buyback. Used to buy shares from small investors holding odd lots, less than marketable lots. Example: TCS announces a buyback through the tender offer method, offering 4,000 rupee per share. Shareholders who accept get money, and TCS reduces its outstanding shares. Easy to remember line. Tender, market, odd lot, 3 buyback shots. Conclusion. Companies use different buyback methods based on strategy, budget, and investor type. It helps in improving EPS and shareholder value. Next important short question is: 5. Corporate Insolvency Resolution Process, SERP. SERP is a legal process under the Insolvency and Bankruptcy Code, IBC, 2016. It helps companies that cannot repay their loans to either get restructured or be sold to new owners. Key steps of SERP. 1. Default occurs, company fails to pay loans. 2. Application filed by creditor or company itself to NCLT, National Company Law Tribunal. 3. Moratorium begins, all legal actions and interest stop temporarily. 4. Insolvency Professional, IRP, takes control of company operations. 5. Committee of Creditors, COSI, made up of lenders, they decide what to do next. 6. Resolution Plan, a plan is submitted to save or sell the company. 7. Approval, if COSI agrees, 66% vote, plan is approved by NCLT. Example: Jet Airways went through SERP after failing to repay debts. A resolution plan helped revive the airline under new ownership. Easy to remember line. Fail to pay. SERP shows the way. Conclusion. SERP helps save failing companies, protects jobs, and ensures fair repayment to creditors. Next unit 4. Long questions. First important long question is: 1. Tools for developing an effective capital structure. Capital structure means the way a company finances its operations using a mix of debt and equity. A good capital structure helps a company grow, reduce risk, and increase profits. To make the capital structure effective, companies use several tools or techniques. These tools help in deciding the right balance between debt and equity. 1. EBITDA analysis. This tool helps to compare the effect of debt and equity on the company's earnings per share, EPS. It shows how different financing options, loan or shares, affect profits available to shareholders. Example: if a company uses more debt and EBIT is high, EPS increases. But if EBIT falls, EPS may drop due to interest payments. 2. Cost of capital. Helps in choosing the cheapest source of funds. Companies calculate WACC, weighted average cost of capital. The lower the WACC, the better. Example: If borrowing is cheaper than issuing shares, the company may prefer debt. 3. Cash flow analysis. Ensures the company has enough cash to repay interest and principal on time. A stable cash flow supports higher debt levels. 4. Debt-equity ratio. Measures the company's financial leverage. Ideal ratio depends on the industry, usually to 1 or lower. Example: A to 1 debt-equity ratio means 2 rupees of debt for every 1 rupee of equity. Too much debt is risky. 5. Financial flexibility. Company must be flexible to raise funds quickly during emergencies. This includes unused credit limits or liquid assets. 6. Control considerations. Issuing more equity may reduce promoters' control. So, companies balance this while planning financing. Easy to remember line. Right mix of loan and share makes the capital structure fair. Conclusion: an effective capital structure balances risk, return, cost, and control. Using tools like EBITPA's analysis, WACC, and debt-equity ratios helps companies make smart financing decisions. Next important long question is: 2. Lintner's dividend model and its salient features. Lintner's dividend model is a popular theory that explains how companies decide how much dividend to pay to shareholders. Unlike the older idea that companies always pay a fixed portion of earnings as dividends, Lintner said companies prefer a smooth and stable dividend payout over time. What is Lintner's dividend model? Lintner suggested that companies don't just pay dividends based on current profits. Instead, they consider past dividends, current earnings, expected future earnings. Companies try to keep dividends stable and gradually increase them rather than making big jumps up or down. Key features of Lintner's model. 1. Dividend smoothing. Companies avoid big changes in dividends because investors like steady income. 2. Target dividend. Firms have a target payout based on long-term earnings expectations. 3. Partial adjustment. If current earnings increase or decrease, dividends only adjust partly towards the target. The adjustment is slow, not sudden. 4. Investor expectation. Investors expect companies to keep dividends stable, so sudden cuts can hurt the company's reputation. 5. Dividend decisions depend on earnings. If earnings rise, dividends increase slowly. If earnings fall, dividends don't decrease sharply unless earnings fall for a long time. Example: suppose a company paid 10 rupee per share last year and earned 12 rupees this year. Instead of jumping to 12 rupee dividend, it might increase to 11 rupees or 11 rupees and 50 paise to keep it steady. This way, investors feel confident the company is stable. Easy to remember line. Slow and steady wins the dividend race. Lintner's model sets the pace. Conclusion: Lintner's dividend model helps companies maintain stable dividends by partially adjusting payouts based on earnings. It balances the company's need to reward shareholders and keep financial stability. This model is important for Indian students to understand how real companies think about dividends. Next important long question is: 3 reasons, benefits, and constraints to buyback of shares. Buyback of shares means a company purchases its own shares from the market or shareholders. This can affect the company's financial health and share price. Reasons for buyback of shares. 1. To return surplus cash. Companies with extra cash may buy back shares to give money back to shareholders. 2. Increase earnings per share, EPAs. Reducing the number of shares increases EPAs, which can make shares look more attractive. 3. Prevent takeovers. Buying shares from the open market reduces the number available for a hostile takeover. 4. Signal confidence. Buybacks show the company believes its shares are undervalued, which boosts investor confidence. Benefits of buyback. 1. Improves share price. Reduced supply of shares often increases their price. 2. Tax benefits. In India, buyback tax rules may be more favorable than dividends for shareholders. 3. Flexibility. Unlike dividends, buybacks are optional and can be done anytime. 4. Control over shares. Helps management control ownership and reduce dilution from employee stock options. Constraints of buyback. 1. Costly process. Buybacks require cash, which may limit funds for business growth. 2. Regulatory restrictions. SEBI rules limit the amount and timing of buybacks to protect investors. 3. Market perception. Frequent buybacks might signal lack of profitable investment opportunities. 4. Impact on financial health. Using too much cash for buyback can hurt liquidity and increase debt risk. Example. Infosys often does buybacks to return extra cash and improve shareholder value without paying dividends. Easy to remember line. Buyback shares with care, good for price, but watch the cash flow scare. Conclusion. Buyback of shares is a powerful tool for companies to manage cash, share price, and control. But it must be done carefully, keeping benefits and constraints in mind for long-term success. Next important long question is 4. Financial distress restructuring. Financial distress restructuring is the process a company undergoes when it faces serious money problems and can't pay its debts on time. This process helps the company avoid bankruptcy by reorganizing its finances and operations to become healthy again. What is financial distress restructuring? When a company is in financial distress, it may have too much debt, poor cash flow, or losses. Restructuring means changing its debt agreements, reducing costs, selling assets, or finding new funds to survive and grow. Key methods of restructuring. 1. Debt restructuring. Negotiating with lenders to reduce interest rates, extend loan periods, or reduce the loan amount. 2. Equity restructuring. Issuing new shares or converting debt into equity to reduce debt burden. 3. Asset sales. Selling non-core or underperforming assets to raise cash. 4. Operational restructuring. Cutting costs, improving efficiency, or changing management to improve profits. Example. Jet Airways went through financial distress and restructuring to avoid shutting down. They negotiated with lenders, cut costs, and tried to bring in new investors. Why is restructuring important? Helps the company survive tough times. Protects jobs and business reputation. Maximizes value for creditors and shareholders. Avoids legal liquidation, which is costly and damaging. Easy to remember line. In financial trouble? Restructure on the double. Conclusion. Financial distress restructuring is a smart way for troubled companies to fix their money problems and come back stronger. Indian students should know it's about negotiation, smart planning, and sometimes tough decisions to save the business. Next important long question is 5. The Insolvency and Bankruptcy Code, IBC, 2016. The Insolvency and Bankruptcy Code, IBC, 2016 is a law in India created to help businesses and individuals who are unable to pay their debts. Before IBC, there were many separate laws and processes that made it difficult and slow to solve financial problems. IBC simplified and united these rules into one powerful law to quickly resolve insolvency and bankruptcy cases. What is IBC 2016? IBC provides a clear process for recovering debts and resolving insolvency for companies, partnership firms, and individuals. It aims to protect creditors' rights while giving struggling companies a chance to revive or close in an orderly way. Key features of IBC. 1. Time-bound resolution. The insolvency resolution process must be completed within 180 to 270 days to avoid long delays. 2. Corporate insolvency resolution process, SERP. When a company defaults, creditors can start SERP. An insolvency resolution professional, IRP, takes control to manage the company and find solutions. 3. Committee of Creditors, COSI. Creditors form a committee to decide whether to revive the company or liquidate it. 4. Liquidation process. If revival is not possible, the company's assets are sold to repay creditors. 5. Priority of payments. IBC defines who gets paid first: secured creditors, operational creditors, employees, etc. Example. The IBC helped recover money from companies like SR Steel by speeding up the resolution and protecting creditors' rights. Why is IBC important? Speeds up debt recovery and protects lenders. Encourages responsible borrowing and lending. Helps clean the business environment by removing sick companies. Attracts investments by improving trust in India's financial system. Easy to remember line. IBC 2016, quick fix for debt scenes. Conclusion. The Insolvency and Bankruptcy Code 2016 is a game changer for India's financial world. It helps businesses deal with debt problems faster, protects creditors, and makes the economy stronger. Indian students should know IBC as a key law shaping modern financial management.